All right, so picture this. You're a UK SME owner and you're absolutely slammed,
Right.
juggling everything. Sales, operations, you name it, and probably feeling like there just aren't enough hours in the day. Now, on top of all that, imagine this. UK SMEs are estimated to be overpaying a combined 5.7 billion pounds in taxes every year. 5.7 billion. Think about what even a fraction of that could do for your business. For you. More investment, more growth, maybe even just a little more breathing room.
It's a staggering figure, isn't it? And for someone like you, already stretched thin, I can imagine tax planning might feel like just another complicated thing on a never-ending to-do list. But honestly, being smart about your taxes isn't just about keeping HMRC happy. It's about having more control over your own bottom line.
100%. So look, consider this deep dive your express lane to tax smarts, all right? We've gone through all the latest data, the expert insights to bring you the core strategies for effective tax planning for UK SMEs in 2025. No need to drown in a sea of jargon. We're cutting straight to what will actually make a difference for you.
And I think it's crucial to remember the context here. The UK tax landscape, it's not static. It's constantly evolving. New regulations pop up, things change. So staying informed and being proactive is more important than ever.
Couldn't agree more. So let's jump right in. When we talk about smart tax planning, where do we even begin? Well, everything we've looked at seems to point back to one of the very first decisions you make for your business, how you structure it. This isn't just paperwork. It really has huge implications for how much you'll end up paying in taxes.
Absolutely. The legal structure of your business is fundamental because it dictates how its profits are taxed. You've got options like being a sole trader, forming a limited company, a partnership or a limited liability partnership, an LLP. And each of these has its own set of tax rules, its own advantages and things you absolutely need to consider. It all depends on your specific circumstances.
Right, so let's unpack those a bit. If you're operating as a sole trader, the main thing to understand is that your business profits are basically treated as your personal income. So you'll pay income tax and national insurance contributions on those earnings. National insurance, just to clarify, goes towards things like state benefits and the state pension, the plus side. Setting up as a sole trader is usually simpler, less admin to worry about.
True. It's often the fastest way to get started. But here's the thing. As your business grows, as those profits increase, those personal income tax rates can really start to bite, especially if you hit those higher tax brackets. And remember, with a sole trader, legally, there's no distinction between you and your business. That means unlimited liability. Any business debts become your personal debts.
Now let's switch gears to the limited company structure. This is where you create a separate legal entity for your business. The company itself pays corporation tax on its profits. Then when you, as the owner, take money out, typically through a mix of salary and dividends, that's when you pay income tax on that personal income.
What's interesting here is that this separation creates opportunities for strategic tax planning. For example, you might decide to take a smaller salary, maybe even keep it below the threshold where you start paying income tax, and then take the rest as dividends. Dividends are essentially a share of the company's profits distributed to its shareholders, and they have their own separate tax rates. Plus, with a limited company, you get limited liability, which protects your personal assets if the business runs into debt. Of course, it does usually involve more admin compared to a sole trader.
Then we have partnerships and LLPs. Traditional partnerships, the profits are usually split between partners and then taxed as their individual income, similar to a sole trader setup, but with shared responsibilities and resources.
And the LLP, the limited liability partnership, it's like a hybrid. It gives you, as a partner, that limited liability protection, similar to a limited company, but often with the tax transparency of a partnership. Meaning, the LLP itself typically doesn't pay corporation tax. Instead, you and the other partners pay tax on your share of the profits. It can be flexible, but it also has its own setup and running costs.
Okay, so let's put some real numbers to this, make it super concrete for you. One of our sources had a brilliant side-by-side comparison of a sole trader versus a limited company, both with an 80,000 pound profit. Let's walk through it, see how this impacts your take-home pay. You ready for this?
Here's where it gets really interesting. Let's look at that sole trader earning $80,000. We deduct the current tax-free personal allowance of £12,570. Then the next 37,700 pounds of income, that's taxed at the basic rate of 20%, which comes to 7,540 pounds in tax. What's left? The 29,730 pounds that gets taxed at the higher rate of 40%, costing 11,892 pounds. And we can't forget about national insurance, which in this case is estimated around £4,908. So for the sole trader with that £80,000 profit, the total tax bill is a hefty £24,340. Take-home pay ends up being £55,660.
All right, let's see how the limited company with the same £80,000 profit stacks up. In this example, the owner's taking a salary of £12,570, right at that personal allowance sweet spot, so no income tax or national insurance on that. Now, the remaining profit in the company, £67,430, that's subject to corporation tax. At the current small profits rate of 19%, that's £12,812 in tax paid by the company.
Now, the owner takes the rest as a dividend. We're talking £54,618 here. Remember, there's that tax-free dividend allowance of £1,000. The next chunk, up to that basic rate limit of £37,700, that's taxed at the dividend basic rate of 8.75%, which comes out to £3,299. And then the last bit, the £15,918, that gets taxed at the higher dividend rate of 33.75%, which is £5,372 in tax. So adding it all up for this limited company, the total tax is the corporation tax, £12,812, plus the dividend tax, $3,299 and $5,372, totaling £21,483.
Okay, quick recap. The sole trader paid £24,340 in tax. The limited company owner paid £21,483. That's a potential saving of £2,857 per year just by operating through a limited company. In this specific case, of course. Think about it. That's money that could be reinvested straight back into your business.
Exactly. And over time, these savings really add up. It's a significant boost to your available capital. But, and this is crucial, this is just one example, the best business structure for you, it's not a one-size-fits-all thing. It depends on your individual circumstances, your profit levels, your risk tolerance, your long-term goals. It's not just about the tax savings right now. It's also about how comfortable you are with liability, how your chosen structure might impact your ability to, say, attract investment or scale your business in the future.
Such an important point. So we've really dug into this foundational decision business structure. Now, let's zoom out a bit. What's the bigger picture, the UK tax landscape you're operating in, as an SME owner in 2025? What are some of the key challenges, the changes you need to be aware of?
Looking at the wider landscape, one of the things that immediately jumps out is the way corporation tax rates are structured. We touched on it earlier, but the main rate is currently 25% for companies with profits over £250,000. But there's that lower rate, 19%, for those with profits under $50,000. And if your profits are somewhere in between, there's something called marginal relief, which basically means your tax rate gradually increases as your profit goes up. It's designed to make the transition smoother, but the calculation can be a bit complex. Might be best to get an expert's opinion on that.
Right, so another area where your specific situation, your profit levels, will influence your tax obligations.
Absolutely. And then, of course, there's the ongoing rollout of making tax digital, MTD. This is big. You're now required to keep digital records and submit your tax information through compatible software. It's ultimately aimed at making things more efficient for everyone, but it does mean you'll need to invest in the right technology and change how you manage your financial data.
So beyond the specific regulations, what are some of the recurring struggles, the common pain points you see SME owners like our listener facing when it comes to tax planning in this constantly evolving environment?
Well, you see a few common themes pop up time and time again. First, as we've discussed, choosing the most tax-efficient business structure. It's a decision a lot of business owners make early on and don't revisit, even though their needs might change as the business grows. Second, simply staying on top of all the tax deadlines, the compliance requirements, can be a real source of stress. Miss a deadline, and you could end up with penalties.
Yeah, definitely something to avoid. What else keeps people up at night?
Figuring out which expenses are actually eligible for tax relief. The rules can be very specific, and not getting this right can lead to a higher tax bill than necessary. Then there's a balancing act of managing cash flow while trying to be as tax efficient as possible. Sometimes the strategies that could save you tax in the long run might temporarily impact your immediate cash reserves. And lastly, and this is very understandable, just finding the time to even think about proactive tax planning amidst the everyday chaos of running a business.
It's like a never-ending juggling act, right? But as our sources emphasized, ignoring these challenges can have real consequences. It's not just about the headache of dealing with taxes, it's about the very real possibility of overpaying, missing out on opportunities to improve your financial position, and ultimately hindering the growth of your business.
Exactly. Overpaying on your taxes directly reduces the capital you have to invest back into your business, whether it's new equipment, hiring more people, or developing new products or services. By not taking advantage of available deductions, or by sticking with a less than optimal business structure, you could be impacting your profitability in a big way.
So, bringing it all back to you, our listener, strategic tax planning, it's not just a box to tick. It's a crucial part of making your business as profitable as possible and ensuring its long-term success. We've seen clearly with that business structure example just how much of a difference it can make to your bottom line.
And thinking about all this, especially those potential savings we illustrated with the business structure comparison, it begs a question. Beyond your business structure, what other aspects of your finances might be unknowingly costing you in taxes? It's worth taking the time to explore other areas where you might be able to optimize and save.
Absolutely. And if this has sparked some questions, if you're wondering how these tax planning strategies could specifically apply to your business, the experts at MA & Co. Accountants, who generously provided all these insights, are offering a free initial consultation to our listeners. You can reach them at 020-8158-8499 or through WhatsApp at 020-3890-9933 or send an email to info@mancoaccountants.com. You can also visit their website, www.mancoaccountants.com, for more information. No strings attached, just a chance to chat about your current situation, see if there's room for improvement.
Taking that proactive step, understand your tax obligations, exploring potential efficiencies, it's not just about compliance, it's about empowering your business to run smoothly and reach its full potential.
So here's to smart, strategic tax planning and a more profitable future for your business. Thanks for joining us on this deep dive.